buy, borrow, die. It sounds like a Netflix drama, but it's actually a powerful financial tax strategy that the rich and wealthy have been using for decades. They've been leveraging it with their private jets, their vacation homes, and multi-million-dollar businesses. But this is something that almost anyone can take advantage of on their path to building generational wealth. Plus, this just got a massive update with the new big, beautiful tax laws. We're talking bigger deductions when you buy assets, enhanced borrowing benefits for businesses, and dramatically increased estate exemptions that protect more wealth than ever before. And once I explain it, you're gonna look at money and taxes like you never have before. Because today, I'm gonna break down how to acquire the right assets, how to leverage debt for the best tax outcomes, and how to build wealth without triggering taxes. Let's kick it off with number one. What is the buy and buy, borrow, die? All right, step one is simple. You want to buy or acquire what are known as appreciating assets, which is just a fancy way of saying things that grow in value the longer that you hold on to them. But what do a lot of people do instead? They spend money on stuff that loses value fast, like cars, clothes, and other gadgets. Those are depreciating assets. They're like ice cubes. Every minute you hold on to them, they actually shrink. But appreciating assets, they're like snowballs. The longer you let them roll, the bigger they grow in value. And that's what we want. We want things that grow quietly in the background while you are earning a living, running your business, taking care of your family, or whatever comes next for you. Now, the best part is when you acquire the right assets, not only can you get appreciation, but you can produce income, passive income. And here's where the new tax law gets exciting. When you buy certain business assets, you can now take 100% bonus depreciation, meaning you can deduct the entire cost in year one. Plus, the Section 179 deduction increased to $2.5 million, giving small businesses massive tax breaks for business asset purchases. Let's talk about a few of those assets. And of course, a lot of people are probably immediately thinking about real estate or stocks. And yeah, those are some good examples. So let's go ahead and talk about number one, real estate. Because out of all the asset types out there, this is probably the easiest one to understand and actually get excited about. Now, when it comes to what kind of real estate to buy, you can break it down into several different options or subcategories. You have personal real estate, which of course will be your primary residence or maybe even a second vacation home. And this is the starting point for most people because we all need somewhere to live. It's a comfortable investment. And the good news is it still is an asset that is likely going to appreciate, which is of course what we want. Then you have short-term rental real estate, which will be property you own and rent out maybe a few nights to a few weeks. Usually these are assets like vacation homes, Airbnbs, cabins, beach houses, condos, or just normal residential property. And this is powerful because three things are happening at the same time. First, you are generating income, which could be positive cash flow coming in potentially every day from people renting your property. Second, the value of the property is likely going up. So while your rental is putting money in your pocket now, it's also building up the value in the background month after month. Now, the cash flow from a short-term rental can be good. I mean, really good. But the beauty of it is you're stacking long-term wealth. And third, you're getting tax benefits because even though the property may be appreciating, you can still depreciate its lifetime value on your tax returns, which can then help you reduce your taxable income. I go through this in a ton of detail in my video on how to use paper losses, so I'll link that below if you haven't seen it already. Now, the big problem with short-term rentals is that it does take more work, and it can be considered more active. Plus, some states and HOAs have started putting in more regulation, making it very difficult to find good investment opportunities. So if you're not a fan of that, then you can try long-term rentals instead, which is the most common and passive type of real estate to have, where you are simply renting your place to someone for an entire year or more. So it's a lot less work. There's no need to clean it every week. There's no new guests coming in all the time. Just steady rent and passive income coming in each month. I personally enjoy over $5,000 a month from my commercial real estate investments, but that's not why I do it. I do it once again because I have tenants that are paying the rent and the property is still growing in value in the background. So that's money now and money later. And the best part is you can borrow against this appreciation, which I'm going to talk about here in a second. But first, understand that real estate is not your only option. You can find many more assets that are growing in value. So let's talk about my number 2, stocks and dividends. Now, almost everyone has heard of stocks. When you buy a stock, you own a small piece of a company. And if that company grows over time, usually the value of your stock grows as well, which is another option for buying appreciating assets. Now, the key is you want to buy and hold. You don't want to be trading the market all the time or trying to time it perfectly. You just buy strong companies and let them grow. And guess what? Some stocks pay you a dividend, which is money that the company shares with its shareholders. So even while you're holding the stock, you could still be earning cash without selling anything. That's why long-term investors love stocks with dividends. They give you two things at once. Okay, you have money now, which is going to be coming from dividends, and then you have growth later with the value of the stocks going up. I personally like to invest in the S&P 500 and currently hold hundreds of thousands of dollars in stock in the symbol VOO. And stocks are one of the easiest ways to build wealth without needing a ton of time or effort. You just have to have the cash, move the cash, buy the stocks, and you're done. Now, those first two were pretty common, real estate and stocks. But if you know anything about me, then you know my favorite appreciating asset to acquire is number 3, business. Now, this might surprise some of you, but for a lot of people, a business is the best asset they'll ever build, buy, or reinvest their money into. In fact, according to a federal survey conducted a few years ago, they found that most multimillionaires keep less cash and have most of their wealth in business interests, even before real estate and stocks. Why? Because this asset can grow faster than almost anything else. When you have a great year in real estate, you may see 10, 20, maybe even 50% return on your cash investment. But a great year in business, you could see 1000% returns, and there's just no other comparison. And yes, at first, it needs your time, it needs your energy, it needs your focus. But over time, if you do it right, it starts growing on its own. And if you reinvest back into it, you're getting better systems, better people, making smart marketing and decisions, then a small business can grow into a real thriving company that can operate without you. In fact, my first business, a social media marketing company, still generates 6 figures per month and runs without me because we have a great management team. And so I'm able to work less than 10 hours per week in that business. And this business is actually what has allowed me to buy more appreciating assets like real estate and stocks and have the time to start stuff like YouTube. Now, the trick is, you don't have to sell your company to get value from it, just like the rich don't sell their homes or their stocks. Instead, you can keep focusing on growing the enterprise value of the business and occasionally accessing the valuation to get a good idea of how your business equity is growing. So whether you're just starting out or you've been in business for years, treat it like the asset it is. Because when you build your business with intention, it can fuel your wealth for life. Now, if you've already checked off the first 3 boxes, then let me start introducing you to a few more assets that are unique, like number 4, collectibles. Because collectibles are another type of asset that can grow in value over time. Things like vintage cars, rare artwork, sport cars, or even first edition comic books. These aren't your everyday items, they're one of a kind. They're limited, they're hard to find. And when something is rare, it gets people's attention. And if enough people want it, that's when the value starts to climb. It's a little like holding a winning lottery ticket, except the longer that you hold on to it, the more it's worth. But unlike a real lottery ticket, you don't need luck, you just need time. Let's take a vintage car, for example. If it's rare, well kept, and has history behind it, it can be worth a lot more 10 years from now than what you paid for it today. Same with art. A piece of art from the right artist can double or even triple in value as years go by. Now, here's the trade-off. Unlike rental properties, collectibles don't give you monthly income. And you need to take really good care of them, keep them clean, store them, heck, sometimes even get insurance. And so this asset is more like a treasury chest. It doesn't hand you cash every month, but it could open up big value down the road. And just like with real estate, you don't always have to sell it to get value from it, and I'll show you that here soon. All right, now I personally don't own any collectibles in my portfolio because finding rarity, it's a skill. You can't just pick random stuff. You should be an expert in whatever you are collecting. Now, this next asset class is one that I have dabbled into, but it's one where people either love it or hate it. I'm talking about number 5, gold and crypto. These are two assets that couldn't be more different, but they're both known for one thing: big swings in value. Let's start with gold. So gold has been around for forever. It's exciting to some people, but others, they don't trust it so much. And so when people get nervous about the economy, they typically buy gold. And in the last year, the GLD stock has grown over 40%. So that shows you what kind of times we are in right now. Now, on the other hand, we have crypto, the wild child of the asset world. It can shoot up fast and it can drop just as quickly. If gold is like a fire extinguisher, crypto is like rocket fuel. It might launch you into space or it might blow up in your face. Now, some people have made millions of dollars in crypto and some have lost millions. I personally held both of these assets and felt like the values dropped immediately after I purchased them. So as soon as I recovered my initial investment, I got out of this particular asset class. But here's my rule. If you invest in crypto, you want to make sure you're investing money you're comfortable with parting with. That means only try to invest amounts of money that won't keep you up at night if it suddenly disappears. Same with gold. Don't expect fast returns. Both of these can be risky investments. All right, now that we've looked at different assets to buy, let's move on to step number 2 and talk about how to borrow and how to use debt in a smart way. Now, this is where things start to get really interesting because you've got an asset that has grown in value. So that means it's worth more than what you bought it for. And what do most people do? They sell it and cash out, right? But what do smart investors do? They don't sell it, they borrow against it. And here's why that's so smart. When you sell an asset, you pay taxes, usually capital gain taxes, and sometimes ordinary income taxes. But when you borrow against it, you get money without owing the IRS a thing. Because when you take out a loan, the money you get is not counted as income, which means it is not taxed. Now, to make it very clear, let's go through an example where you're buying a property. Let's say that it is worth $800,000 and you bought it for $500,000. So that's a $300,000 gain on paper. If you sold it, you would probably owe taxes on that $300,000 gain. But if you borrowed against the property, you can get a loan from a bank, usually through a refinance or a HELOC, and get access to maybe $500,000 or more and still keep the house. That means no sale, no tax bill, just cold usable cash. You keep the asset, you keep the growth, and you get money without selling anything. Then you could use the cash to cover your life expenses, fund your businesses, or just build up a healthy cushion, all without triggering any income taxes. And yes, this is totally legal. The IRS doesn't treat borrowed money as income because technically you're expected to pay it back. In fact, you may be able to write off and deduct any interest payments that you have to make. And here's another benefit from the new tax law. Businesses can now deduct more interest on loans used for business purposes, making borrowing even more attractive for strategic investments. And now, look, I know the idea of taking on debt might sound risky, and the truth is, it is risky. But remember, we're not going to be borrowing money to get into more consumer debt or acquire depreciating assets. Absolutely not. Great investors turn bad debt into good debt by getting good terms and continuing to allow the underlying assets pay off the loan. And when done smartly, this is how the wealthy buy freedom without selling their future. Let me break it down with chapter number 3, acquiring good debt. All right, so now you borrowed against your asset. You didn't sell it, you didn't trigger taxes, and you have cash. Now, of course, if you have an emergency come up, then you'll want to use your cash and your funds appropriately. Otherwise, if you're looking for a strategic play, then use that money to what? Buy more assets or improve your current ones. That's the move. It's called leverage, and this is how wealth starts to compound. Let's go back to our real estate example. You bought a rental property, it grew in value, you borrowed against it, and let's say you have $300,000 in cash. Now, you could use that money to improve the property, like updating the floors, the kitchen, the bathroom, which may allow you to demand a higher rent, thus higher passive income. Or you could even add a new unit. I've been seeing a lot of these ADUs where investors are able to add an entirely new unit on the same property and list it available for rent. But if improving the property isn't a good option, then you could buy a second property. Now you have 2 assets that are growing in value, 2 sources of cash flow, and you still haven't sold anything. Now, of course, this is assuming that your area of expertise is in rentals, but you could do the same thing with stocks, business, collectibles, or other appreciating assets that we already discussed. This is the magic of leverage. The rich and wealthy repeat this over and over. They use one move to fund their next move without draining their foundation. And remember, if you're borrowing to invest in a business or a rental, you may be able to deduct the loan interest on your taxes. So now you're not just growing your appreciation, you're lowering your taxes as well. Now, of course, this isn't free money. You still need to repay the loan, and you don't want to borrow more than you can handle. But when used wisely, leverage turns one move into many. Of course, we've talked about buy, we've talked about borrow. We have to talk about one more part, and this is the most overlooked part of it all, and it has to do with what happens after you're gone. Let's talk about the final step, die. But really quick, before I move on, if you're getting value from this video, do me a favor, like, subscribe, or drop a comment about whatever questions you might have. I'll try my best to answer as many questions down below or even include it in my next video. All right, step number 4, die and buy, borrow, die. This is the part most people forget about. And let's be real, no one loves talking about death, but the die is actually the most powerful move in this entire playbook, because when the rich and the wealthy pass on, so does their wealth without passing on a huge tax bill. How? It's all thanks to something called stepped up basis. Let me break it down. Let's say you bought a property for $500,000 and over time it grows to $1.5 million in value. If you sold it while you were alive, you have a $1 million gain. But focus here, because this is where it gets interesting. If you hold on to it all the way until the end, the tax rules do something wild. The IRS resets the value of the asset to be what it's worth on the day that you pass. So your heirs, they inherit it as if they bought the property for $1.5 million. So if they sell it right away, they might owe $0 in capital gains tax. Okay, let that sink in. You built all that value during your lifetime, and your heirs receive it at full value without triggering taxes. It's like passing a baton at a relay race, but instead of slowing down, your family gets to start at full speed. This is why the rich rarely sell during their lifetime. You see, they borrow, they reinvest, and then they wait, because the step-up basis makes the biggest tax problem disappear legally. Now, here's a very important note. Right now, this is the law, but tax law can change. However, there's incredible news. The new 2025 tax law just made this strategy even more powerful. The estate tax exemption has been permanently increased to $15 million for individuals and $30 million for married couples. That's up from the previous $13.61 million limit. This means even more families can now pass wealth to the next generation
without triggering federal estate taxes. We're talking about protecting millions more in family wealth. Also worth knowing, estate taxes only apply once your assets go over that $15 million threshold now, double what most people were planning for only a few months ago.
So the best time to plan is right now, because if you structure things right, you're not just growing your wealth, you're keeping it in the family where it belongs. Which brings us to the grand payoff in chapter number 5, the wealth loop. Now that you've seen the full playbook, let's zoom out. The strategy is simple. Buy appreciating assets, borrow against them instead of selling them to avoid taxes, and when the time comes, let your family inherit those assets tax-free. That's buy, borrow, die. And when we put it all together, it creates something bigger than just a strategy. It creates a wealth loop, a quiet, powerful system that the wealthy use to keep their money working year after year, generation after generation. And what do a lot of people do instead? They earn money, they pay taxes, and they spend whatever is left, meaning they start over every year, every quarter, every dollar. But if you want to leave a legacy and build generational wealth, then it's time to start playing a different game.
And with the new 2025 tax advantages we just discussed, there's never been a better time to implement this strategy. Bigger deductions when you buy, better borrowing benefits, and dramatically higher estate exemptions mean you can build and protect more wealth than ever before.